Thank you for joining the Acquisition IQ podcast. My name is Nathan Bird, founder of Acquicon, as well as Acquisition IQ National Network. And today we are joined with Mitchell Rice. Mitchell is the founder of Elkstone Capital. You help investors protect and multiply their wealth through strategic passive investments in commercial real estate. With over 45 million in assets under management and over 450 doors, Mitchell doesn't just invest in buildings, he builds long term trust. If you're looking for a recession proof, resistant asset class with tax advantages, leverage, and real world utility, Mitch is your guy at Elkstone Capital. Thanks a lot for joining us today on the Acquisition IQ podcast.
Yeah, thanks for having me. Stoked to be here, man.
You know, there's all sorts of investment classes, right? You've got multifamily, single family, alternative investments, fund to funds, all the things that we know, and being able to deploy capital. What makes real estate the best investment in your mind?
So also including VC, private
Yeah.
equity, we're talking everything. So I've got to defend real estate
Well, as an investment,
as an investment.
Mhm.
I'd say the risk profile, it's very low risk, especially multifamily. That's one of our focuses at Elkstone Capital. Everybody will always need a roof over their head. So if you buy great multifamily in a great market, it's going to be very hard to lose money. And then the second answer I would give is for the tax advantages. Real estate is a tax shelter. So ultra high net worth individuals, this is where they're pouring money into once they've made a lot somewhere else to avoid taxes. I'd say those are two of the reasons that set real estate apart from everything else.
Let's dig deeper into the tax implications, and then maybe create a scenario that I'm sure we're all familiar with, but I think it'd be important to hear it from your perspective.
Yeah, so I mean, there's a couple different tax advantages. First, I can think of is 1031 exchange. So a 1031 exchange is when you sell a real estate asset. Let's say you sell it for $1 million. You get to roll over into another deal that costs more than that deal. It needs to be like kind, but you get to defer capital gains. So instead of paying capital gains when you sell the property, you have 45 days to ID. So identify 3 options to roll over those funds into the next deal. And then once you've ID'd those options, you have 180 days to close. And if you successfully do that within that time frame, using a qualified intermediary, then you defer those capital gains. So that's one strategy. Another is just depreciation. Real estate, you get lots of depreciation when you invest in. So if you have a lot of passive income, for example, we're doing a deal right now where if you invest, for every dollar you invest, you get 80 cents back in depreciation to go use to offset any passive income that you have.
Super wise, and obviously, you guys are seeing it firsthand with the fund that you've created and the investments you're making. I've got, we're at, say for example, let's create a scenario again, and you're now wanting to acquire a piece of property.
Yep.
Or acquire as an investor, because I like to both. We're going to take 2 seats here. We're going to do both the investor seat, like what you sit in, as well as the investor looking for an investment. So for now, let's look at the investor now is looking for that acquisition deal. And how do you, and what do you look for actually?
So how do we find deals?
Yeah.
So yeah, that's a great question. In fact, I've spent the last 5 months searching for the next perfect deal. Our last acquisition was Q1. We haven't had anything since. So what the first year, the half of this year looked like for us was heavy underwriting. And the rest of this year is going to be heavy capital raising and relationships. So finding a deal, I mean, first step is you need deal flow. And you get that through brokers. And you can go about that 2 ways. You can either look for on market, so stuff that's already listed with the brokerage, or you can create relationships with the brokers and try to get them to give you off market deals. Once you found a deal, we have financial models. We use Excel. We underwrite it. So we take, we ask the brokers for the trailing financials. So we look at, okay, what were all the financials for the property over the last 12 months? We ask for the rent roll so we could see the tenant base, how much they're paying, for the 1 beds, the 2 beds, 3 beds, whatever the unit mix is. What's the remaining life of those leases? How long do tenants stay at the property? We plug all these numbers into our pro forma, and typically we project our returns over a 5-year hold. So over 5 years, we're looking at, okay, here's what our income is now. Based on this area, here's what we think rent growth will be. So this is what we think And maybe rents are under market or maybe they're already at market. But here's what we think we can push rents to over time. Here's our expenses. We work with local property management companies to provide us data and assumptions of what's going to cost to run everything, whether that's marketing, administrative, utilities, turnover costs. And we create a pro forma and we project returns over a 5-year hold period.
Making an investment, obviously, you're wanting to mitigate risk. And what are some ways that you're looking at mitigating risk as an investor? Can you elaborate on that a little bit more?
Yeah, definitely. So not overpaying. In my mind, that's number one rule of real estate is never overpay. And I think that's one trap a lot of first-time investors fall into is they have a deal that a broker, brings to them, or somehow they find a deal and they get emotionally attached to it. There's real estate everywhere. So you should never overpay for real estate. And I even made that mistake early on with one of my deals. I didn't buy it, but I just spent too much time analyzing it when I should have had a better system for doing a back of the napkin up front, to know, okay, here's what I have to pay for this to be able to get the returns my investors need. And, okay, let's go take this value to the brokers. Is this a realistic price? Would the seller ever part ways with this asset at this price? So long story short on that asset, I spent like 2 months analyzing the dang thing, calling the city, making sure our business plan would work. But the first thing I should have done is take what I know the deal will pencil out. What's that purchase price? Go ask the brokers, will the seller entertain this offer? And I wasted my time because he was like $3 million over what I needed to make it pencil. So I'd say don't overpay. That's step one.
Looking at the valuation, though, and how do you determine valuation? I'm sure there's a lot, right? You've got global, micro, macro economics, but
so all commercial real estate is valued on the income method. So have you ever heard of a cap rate?
No, let's do it.
So so a little logistical, but let's say you have a property and the seller wants $10 million for it. It's generating $1 million in annual NOI, so net operating income. NOI is the income before paying your interest and principal payments, so it's before debt service. So let's say this $10 million property is generating $1 million annually. You take that $1 million NOI, divide by 10 million, you get a 10% cap rate, right? So that is the cap rate, and cap rate is the yield. It's what is this property generating annually in yield. That's what cap rate is. And that's how all commercial real estate is valued. So if I was going to value this office building that we're sitting in right now, I would need the financials so I could see, okay, what's the in-place net operating income over the past 12 months? And then, maybe I don't understand the office market for Sandy, Utah. So I'm going to call the best office brokers in the valley. I'm going to say, hey, what's recently traded hands? What have you recently sold? Okay, what cap rate did those sell at? And maybe I find that they're all trading at a 7 or an 8 cap. So the inverse of that formula, if I'm trying to get to price discovery, now I take the NOI over the past 12 months and divide it by that cap rate, and I get value. That's it.
Beautiful.
That's the formula for how to, anything you see driving down the street, that is how value is discovered.
Speak with us a little bit more of your previous, your previous professional experience. I know that you've been in finance for a while.
Yeah.
To be able to understand what you're talking about, I think it's really important for also the audience to understand that as well.
My background's really interesting. I came out of school and I went and worked for the Mormon Church's for-profit real estate investment arm. Okay. So a lot of people have heard of Ensign Peak. They run the stocks and the bonds. I worked for their sister company, and we were buying office. We were buying hotels. We were buying apartments. We were building warehouses for Amazon. We were building townhome communities. So you
were looking at some pretty big deals.
Oh yeah, huge. Average deal size was typically 100 million plus. And I was the main analyst, so my job was to underwrite those deals, do everything that we just talked about, forecast the returns, and then go to investment committee every Friday and tell them if we should do or not do the deal.
So it was only natural that you would start your own fund. I mean, come on now.
Yeah, I mean,
or stay at that job forever.
Well, the reason I didn't stay there is because I had it easy. I didn't have to raise any equity. I didn't have to source debt because not only are their deals unlevered, which means they don't use debt, so they use 100% cash, but also on the equity side, so on the cash side, they don't go out to private investors like any other normal group would. All their funds are internal, so it's an internal approval process, whether the deal gets done or not. And so that's experience that I felt like I wasn't getting, and I really needed to get out, start my own fund and start building those relationships with investors, with lenders, and have that network.
That's so good. I mean, I feel like, and for those out there, it's interesting. What are some of the words of wisdom that you would give to those who maybe are just a smaller step behind you, in their aspirations to be, getting into real estate investing?
So investing passively with another sponsor, or doing what I
Oh,
did and starting a fund or
let's look
starting
at
to
a fund
syndicate.
first, and then we'll talk about the investment side. Yeah.
So yeah, if you're gonna leave the comfortable W-2, I would say at least make sure you had experience working on real meaningful deals. At that position where you were, you had sizable responsibilities that you can talk to that help with your track record. Um, the other one is make sure you have a big emergency savings, because you're gonna go a long time without making money, and that's exactly how it was for me,
Mm-hmm.
and especially with syndication. So to put into perspective, the 160 unit deal that we have tied up right now in Indiana, it's taken me 5 months and my interns just to find that deal. Now it's going to be another 3 months to capitalize it, to raise the 6.6 million we need to close it, to get our debt, and then we're going to have to manage it for years. And the way syndication works is, at least in real estate, we take an acquisition fee up front, usually anywhere from 1.5% to 3%, and that feeds the mouths of the GP team for the next 5 years. We have to survive that long because our investors get a preferred return.
Mm-hmm.
So in this deal, we're offering 8%, which means up to 8%, all cash flow that the property generates is going straight to the investors. We don't touch it. And then it's an 80-20 split. So we're not living off the distributions of any of these projects. Where the sponsor makes their money is when they sell the asset successfully at pro forma 5-7 years down the line. And that's when we get promote, typically. So I would say anybody contemplating this, got to have a big emergency savings, and you have to be able to last for a long time until those deals start going full cycle.
Mm-hmm. It's very wise. Yeah. I'm an investor looking at ways to diversify my income. And obviously, we're talking about real estate right now. So let's dive into the typical length of time that you're seeing from an investor who has expectations on their return. I know you just simply stated a certain amount, but
Yep.
do you have any other individuals that have come to you and saying, I'd like a 1 year return? I'd like a
Yeah.
3 year return.
If
What does
they
it look like?
if they do, that's the beauty of real estate. There's different strategies. So, like, for example, ground up development, you're taking raw land, you're building something from the ground up. You're not going to have cash flow on that for the first few years, right? But the IRR on development deals traditionally is the highest. It's where there's the most margin, or at least it should be.
But it takes the longest to get return.
To get cash
Typically.
flow, yeah.
Okay.
But I guess, every deal's a little bit different, because that development, typically, if you invest in a development syndication, you won't build it and then sit on it for years and years. You're going to build it, stabilize it, sell it. That's going to help your IRR, because IRR is time value of money sensitive. So as soon as you can lease that property up and then sell it, the better your IRR will be. But you're not going to have cash flow until you start, to get it rented, start getting tenants in the building. So, contrast that with an acquisition. It's already full, it's already occupied. So you're stepping into cash flow day one, but maybe there's not quite as much meat on the bone as a development.
True.
So there's so many different strategies.
I know, like what we talked about, and I had seen from you prior, was a multifamily hotel that was converted into an apartment complex.
Yep.
Well, that was one of them, and then there
That's
was
one
a
of them.
secondary one that we also walked through. And tell us a little bit about that one specifically.
That deal that you and me walked.
Yeah.
So funny story, they actually reached back out to me this week. So that deal was a year ago. Nate walked the property with me, and we were negotiating terms with the seller, and I just couldn't get to a price that I was comfortable with. After underwriting, I didn't feel comfortable with where the returns were, and I told investors, hey, let's go find another deal. This one's just a little too expensive. The investor wanted like a 4.7% going in cap rate, which means for the price we were paying, for the income we were getting, the property was only going to yield 4.7% annually. And that's just expensive.
You could take that money somewhere else and
get
10% or something.
Yeah, exactly. Yeah. And so we walked, but they actually just reached back out this week and said, hey, we're ready to come down a couple million. Will you look at this again? So we're diving back in.
Contemplation.
We'll see. It's all about the model. We're going to re-underwrite it. So now I have to get the new financials because
Mhm.
so much could have
It's
changed with this property over the past 12 months. Especially in Ogden, I know for a fact that rents have come down, rents have softened. So that's what I would expect to see with the financials. So we better be getting a discount, or I know it's definitely not going to work. So that's the story with that deal.
interesting. There's all sorts of investors again. I mean, shoot, you know, your returns, but I feel like real estate is just, it's been over the course of time, it's been something that, again, we as humans, we've got to have a roof over our heads, like you said. And it seems to be a pretty safe investment, for many years.
Yeah.
Yeah.
A- And before I jump into that, I just want to clarify one thing because on our last question, Nate, you mentioned you could go get 10% somewhere else. So I just want to clarify that the returns we've been talking about is the cash on cash return, the
Okay.
cash flow. IRR and cash flow are very different. So cash flow is just looking at, okay, what is the property generating, after you're paying everything, what is the cash flow available for distribution as a percent of the total equity amount put into that deal. IRR includes the terminal value. So, for example, the Indiana deal, our IRR is 15% annually when you factor in what we think we'll sell it for in 7 years. So, just
Yep,
making
that's
sure you
good.
didn't get the impression that real estate returns suck because they're better than 7. That's just what you actually are getting in cash flow.
Mhm.
But when you factor in what you're able to sell it for, IRRs typically range from 15 to 20%.
I mean, we have investors that watch this, and then also they're wanting to get into various forms of investments. And again, this isn't, hey, invest in this specific thing, or receive a certain amount of return. But um, what do people typically return? What is the return or expected return on, over percentages, but also like a range of some sort? And then also, well, yeah, I guess you could touch on that first.
Yeah, so IRR, if it's like a heavy value add deal right now and we're putting 10,000 into each unit, there's construction risk involved in that.
True.
There's stabilization risk, meaning lease up risk, because if you're taking units offline, your occupancy is going to drop in the short term and you're going to have to get it back up once all your units are done being renovated. So for value add, we typically target 18 to 20% on IRR. So again, that's looking at all the inflows and outflows over the life cycle of the deal, discounting it back to today. So 18 to 20% return. As far as cash on cash return goes, let's take an acquisition, for example. We like to buy stuff that at a minimum has a 4% year one cash return. So, I mean,
That's good.
that's nothing special. That's like a bond. We're going to increase that every year. Typically, there's going to be a business plan. We should be able to push that. So what I look at over the hold period, say we have a 7-year hold like our current deal, I'm going to look at what's our rent in year 1, 2, 3, 4, all the way through 7. What's the average? We're at 7.5 on that deal, which is strong. For multifamily, that's great. And then the third metric investors look at is the equity multiple. If you put in 100 grand, how much do you get back? If you get back 200, you had a 2x equity multiple. And that's kind of the gold standard for real estate syndication I try to make sure our LPs double their money over 5 years.
When does distribution come out as an investor of a project?
It just depends on this deal. We're doing it. So assuming we close mid-September, by the end of the year, they should get their first distribution. And then we pay quarterly distributions.
Quarterly.
Yeah.
Is that industry standard?
No, some people do monthly, some quarterly.
Okay.
I don't know that if I've seen longer than quarterly. Usually it's one of those two. Um, in my mind, I like quarterly because monthly, it's just more work from an accounting perspective. We like to update monthly, but I think quarterly is a sweet spot for distributions.
Yeah, this is good. Obviously we have tactics and strategies, but I also like to get to know the guests a little bit more on this podcast
Yeah.
as well. So share with us what your vision is for Elkstone Capital and how you foresee your future.
My vision is to genuinely help investors get ahead. This industry, there's a lot of good eggs, but there's also a lot of bad eggs. There's a lot of nightmares out there. And I want to do everything in my power to eliminate that stigma 100%. And I'll never be able to do that. The world's too big. There will always be people who are doing bad deals. But I want to control the ball that's in my court, and I want to make sure that any investor who invests in one of our deals over the next 30, 40, 50 years is going to have a good experience. And if something happens that's out of my control that causes the deal to go south, I want them to know that I'm gonna hustle. I'll do everything I can to fix it, night and day.
Mm-hmm.
So that's what I live by, and our goal is to get to $1 billion in assets under management.
Okay.
Over,
You can do it.
yeah, I think it'll take 7 years, but
only 7. That's good. I'd like to touch on who are the bad eggs. Not exactly who, but what makes just a terrible investor, or sorry, an investment, and then how
yeah.
do you look for that as an investor?
Yeah, I think the most obvious thing is if somebody brings you an investment opportunity and they don't have a good financial model, it's scratch numbers on a piece of paper. They don't have a sophisticated pitch deck. Immediately, that's red flags, right? They better have subscription documents. They better have a sophisticated investor portal. They better communicate with you very clearly and efficiently throughout the process of just trying to solicit your investment. If they're not already doing all that, those are immediate red flags that I see.
Yeah.
And then just the deal itself, like even the best sponsor, the most honest, trustworthy, smartest person, if they do a bad deal, that's going to create pressure. And that pressure can contribute to them then doing something worse. If they're on the hot seat with investors. So
and it'll just snowball.
It'll snowball. Yeah. So try not to do bad deals and try to do deals with sophisticated.
And even sponsors. When you do a bad deal, I think like what you just said, I think it's completely owning up to and communicating with those that have entrusted you. I think that's really important too, from more of the the fund manager side, but then also from an investor standpoint. I mean, you want those updates.
Definitely.
I mean, obviously some more than others, because some people just want their money to work for them and they don't really need
a lot. Some don't care. You'll never hear from them. But others, they want to know what's going on, and it's exciting. That's how they want to learn. They want to learn as well. Mm-hmm. And so I guess that's another mission, is I get to educate them about real estate and how cool it is, and they get to learn and grow.
Acquisitions. I mean, it's in essence a diversification of your portfolio as one who would want to acquire. And what about real estate in the form of businesses, that have real estate? Have you looked at those, and what do you typically do?
Yeah, this is a perfect segue into Acquisition IQ, because that is the goal of Acquisition IQ, is to help the members achieve what you just said. I'm just starting on the big business acquisition route. I have a goal to buy something, whether it comes with the real estate or not. I don't care, but this is super cool what you're doing, and it's on my radar, and that's why I come to the Acquicon events, because I want to buy a business, whether it's real estate adjacent or something totally separate. That lifestyle sounds very compelling.
It's interesting. I've been looked at too. It's just owning the real estate. That the businesses, obviously, that's just commercial real estate. Then that the businesses then rent from you, and then you're just in essence become the landlord. But I feel like for you, for example, with Elkstone, there's a play there too, which is owning the commercial real estate as well. In tandem with your multifamily.
Oh, totally. Now I get what you were asking.
It's just one of those things. I guess you probably have it on your roadmap.
But yeah, that definitely is more commercial, because even though when we say commercial real estate, that also includes multifamily and apartments. You're talking about commercial in the sense of an office with one large tenant, or a warehouse with a tenant. It might be a triple net lease, which means the tenant pays the tax, insurance, and the maintenance themselves. Or it's full service, which, like a lot of those sexy office buildings on Silicon Slopes, are full service, which means the landlord, the owner of the office, is paying those expenses, and they're just paying some base rent. That's an incredible strategy. Office right now, there are insane discounts to go buy sexy office buildings if you can capitalize them.
I've got a question for you as far as the future, and I think this would be helpful too for us, is, considering that you're in real estate, you're continually just living and breathing it, and just understanding the future of it as well. What is your perspective on the future of commercial real estate, and what are we going to see 3 years from now?
Yeah, so
you never predict the future, but
yeah,
again,
So I already mentioned a couple asset classes that fall into that. So warehouse and logistics. You go out to the airport, there's massive 1,000,000 square foot boxes being rented by, the Amazons of the world, manufacturing companies, large distribution companies. There's office, there's retail, um, life science, data center. All that in my mind kind of falls under what you're asking. Office obviously got hit hard because of COVID and the work from home trends that we've been seeing. But from everybody I've been talking to, people are slowly coming back to work and employers are requiring it. So I think office is going to make a comeback. Um, Warehouse has been one of the sweethearts. It's been one of the darlings of commercial real estate all throughout COVID. It's been strong, just with, especially if manufacturing gets nearshored, with all the tariff stuff, and more companies start manufacturing product here on American soil. That's only going to increase demand for warehouses and for fulfillment facilities. Data centers, everything's moving online. You've got the AI trends. There's so much data processing requirements that we need. So more data centers are going to pop up all over the place. Retail, I was in a shopping mall in Vancouver 2 weeks ago, and there were so many people, I couldn't believe it, and it made me feel good. Like
Yeah.
I was happy to be in public, see so many other people enjoying it with their families, and that was cool, and that's what real estate's all about. And I don't think that will go anywhere either.
That's
yeah,
good
those are my
insight.
thoughts.
Yeah, because there's, they say interest rates and they say tariffs and all these things, but sometimes, you don't know what to make of it. But
Yeah.
those that are in the industry, maybe, you have a deeper insight as to what it is and how one can apply it.
Yeah, and on the interest rate, look for an assumable rate. So on that property in Indiana, we're assuming the debt, 3.5% assumable interest. It's fixed for 7 more years. That's
Wow.
what makes that deal tick. So yeah, it gets harder to pencil any deal right now at 6%. It can be done, but if you can find a loan that you can assume, then yeah, you're off to the races.
That's gold right there.
Yeah,
Assumable loan at the percentage that was previously allocated for the amount of years that are left on it.
exactly.
Yeah, that's good.
We step in, we keep paying on the note.
So what's the future hold for you? And, again, we just want to say thank you for joining us here today on the Acquisition IQ podcast.
Yeah.
But how can we as a community support Mitch with the Elkstone Capital?
I would say don't be afraid to talk to me. I think a lot of people refrain from asking for advice or education. That's what I'm here for. I'm not going to request that you invest with us just because I spent a couple hours educating you. That's part of it. So I want to educate you. Come to me with all your hard questions. If you're contemplating investing in somebody else's deal, send me their pro forma. I'll vet it for you. I'll tell you if it's good or not. I'll give you a totally unbiased opinion, because I've seen hundreds of these. I know what's going to pencil and what isn't. So I think that is hard for a lot of sponsors to do. Obviously, we have a bias, hopefully that you invest with us in our deals. But I'm not going to be that guy. I'm just going to point you straight, whatever you ask. So don't be afraid to lean on me as a resource, I'd say.
Well, guys, we've got Mitch here with Elkstone Capital. He joined us today with the Acquisition IQ podcast to give you just a little bit of an insight into the real estate game as both an investor as well as one who is running a fund. So thank you for those two different perspectives. I was just hoping that we could draw that out in you today, and you did a great job.
Thank you.
We just want to say thank you again for joining us today on the Acquisition IQ podcast. And, we have the acquisition conferences coming up here September 3rd. And with our initiatives to help to provide the education, just like what you said earlier today, it's super important to do so. We want to make generational change and provide people with access to information that they may not have already access to. I know you said something prior and, about the Acquisition IQ network. And, we just wanted to say thank you so much for being a part as a founding member.
Yeah, happy to do it. Appreciate you having me.
And, with the Acquicon coming up, again, it's on September 3rd. Inside of the room, we're going to have one circle table. So we've got about 200 to about 250 individuals. We have different speakers. So one speaker will speak about fund creation. We'll have another that's speaking about acquisition strategy. We'll have a buyer panel, a buyer slash private equity fund panel that's very specific about fundraising and then also the deployment of capital and how to do so, and then also how to raise. So that's really important. And we do have a sell side panel as well that's going to provide insight to the value creation within your business so then you can maximize your exit. We have a negotiation specialist who's going to come in and talk about how to leverage building relationship and understanding communication tactics and techniques, both body language, all the things that you've got to go through while you're in negotiation. I think that'll be really valuable.
That's cool.
But yeah, we just want to say anything else?
The day goes by quick. I'll say that.
It
You won't
does,
even look at
yeah.
your watch. You'll snap your finger
Yeah.
and you'll be walking out. That's how fun that day is.
But guys, thanks a lot for joining us today. If you want to get a hold of Mitch, what's the best way to do so?
Get my number from Nate or
Okay.
look me up on LinkedIn. LinkedIn, Instagram. Go to Elkstone Capital Partners.com.
Okay.
Lots of ways to find me.
Perfect. Well, thanks again for joining us today on the Acquisition IQ podcast. And if you like today's episode, feel free to share it with your friends and also comment in the description below what you guys want to see next. So we're going to continue to create value, create access, create education, and do it for the world. So thanks a lot.